Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned into the inaugural edition of On Trend. This is the show that is designed to keep you on the right side of the trend. And today's show is actually very timely because what we're going to be doing is covering the S&P 500 and the 200-day simple moving average. And we're going to show you how that moving average worked over time, how many signals there were, how those signals panned out, whether you made money or you lost money, if you got whipsawed. And then we're going to show you a way to smooth it out a little bit. Not the 200-day, but a moving average in front of that 200-day to give you fewer signals and actually improve your returns. So here's what we're going to talk about today. First, we're going to show you how to pick the market. In other words, if we're going to look at one index, what index is it going to be? I'm sure you can figure that one out already, but I'm also going to show you why I think it's the index to use. Then we're going to assess the humble moving average with that index to see if it does work to keep you on the right side or keep you out during a bear market. In other words, the right side is in during a bull market and out during a bear market. And then we're going to show you how slow and steady wins the race. If you slow it down a little bit, you can catch that trend and you can avoid whipsaws and you can play longer. So we'll start off with first things first, because in general, I advocate being in during a bull market or looking for long positions during a bull market and out during a bear market. I don't like to short stocks because bear markets tend to be violent. They tend to have sharp counter trend rallies. And so it is often very difficult to short stocks even during a bear market and make money. But the moving averages I'm going to show you and the market are designed to keep you on the right side of the market. Trying to take some of the thought out of it and try to make it more quantifiable, if you will. So the S&P 500 is the market as far as I'm concerned. It's 80% of the investable U.S. equity market, by far the lion's share of the U.S. market. Some $7.8 trillion are benchmarked to the index. And we know that institutions are the ones that have the big buying pressure, the big selling pressure. They're the ones that are pushing the market around, and they're using the S&P 500 as their benchmark. By extension, they're also investing in the leading companies, and there are 500 leading companies in the S&P 500. 85 stocks in the NASDAQ 100 are also in the S&P 500, and of those 85, they account for around 1/3 of the S&P 500. So the NASDAQ 100 is also well represented within the S&P 500. So here's the S&P 500 over the last 25 years, and we can see three big bull runs during the last 25 years. You had that big run from 94 until 1999, another one from the 2002 low until 2007, and then of course the 2009 low up until now, or like up over 300% from that 2009 low. So basically what you have is three big bull runs in 25 years. And this is what we want to participate in. Now, of course, with the bull runs come the bear runs. And what we don't want to participate in is the bear market. And you can see we had two bear markets here, 50% decline in 2000 to 2003 or 2, and a 57% decline from 2008 to 2009. Actually, that started in 2007. And also along the way, you had the May flash crash affecting the market. You also had the 2011 decline, the sovereign debt crisis, and of course, that exceptional volatility there in 2015. But what we want to do is avoid these drawdowns and get out of the market at some point before we get to a 50% drawdown. So what if you did buy and hold for the S&P 500 over the last 25 years? Well, it's not too bad. You'd have a 7.31% compound annual return. but that would come at a cost. Your maximum drawdown would have been around 57%. And as you saw on the chart, there were 2 drawdowns that were more than 50%. So that's what you would have had to live through. Enter the humble moving average. It's one of the oldest indicators out there, but it is still an effective way to control risk. And we're going to start with just a simple moving average, 200 days, and the closing price. And you look at this chart and you say, well, how many times did the moving average, or did the price close above or below the moving average? And you can eyeball it and say, maybe 50, 60 times. But if you actually quantify it and you run the numbers, 171 crosses in the last 25 years. That is a lot of crosses. Those are a lot of signals. So we want to weed those out. But first, let's see how we would have performed if we had bought on a cross above the 200-day and sold on a cross below the 200-day. Not shorting. This is only a long-only strategy. So you would have had a 6.18% compound annual return. That is not as good as buy and hold. However, your maximum drawdown is under 30%. So instead of 50% drawdowns, you would have had a maximum drawdown under 30%. So it would have hurt a lot less during the bear market. Still would have hurt, definitely. So here's the S&P 500 again with the 200-day SMA and that 6.18% compound annual return. But one thing you also have to keep in mind is you're invested only 74% of the time. So during these bear markets, you're out of the market. So 26% of the time, you're not in the market. And when you're not in the market, that means you're not exposed to risk. So your risk-adjusted return is going to be higher. Buy and hold is exposed to the market the entire time. So its risk-adjusted return is what you see, the buy and hold return. But this risk-adjusted return is going to be higher because you only invested 74% of the time. You can do something with your money the other 26% of the time. Now, 171 signals, that's a lot of noise. It's so much noise, I had to say it 3 times. But I can show you even more noise if you want to see it. Enter the Dow Jones Industrial Average. Now, I know it's a very widely followed average. It's one of the oldest benchmarks out there, but I don't think it's that good as far as trading or timing, and definitely not with the 200-day SMA. If you look at the Dow, there were 229 crosses of the 200-day SMA in 25 years. I mean, look at all those whipsaws. And again, during the uptrend here. So it's not a very good index to use with the 200-day SMA because there were 58 more crosses than the S&P 500. And if you look at the returns for the Dow, you had a 5% compound annual return if you bought on a close above the 200-day SMA, sold on a close below the 200-day SMA, and your drawdowns were up above 40%, your maximum drawdown. So it didn't improve in that category. And that's what we want to use a moving average for. We want to reduce the drawdowns. And it's not working for the Dow. So what we need to do to reduce the drawdowns is reduce the signals, and we need to go a little bit slower. So instead of using the closing price, we want to slow it down. And we want a more of a steady uptrend. And I'm going to show you some techniques using a 5-day, a 25-day, and a 50-day moving average. But first, I want to talk about the difference between the S&P 500, the SPY with dividends, and the SPY without dividends. SPY is, of course, the S&P 500 ETF. So if you look at the S&P 500 without dividends, you can see that you had a close below the 200-day in early April. All right, in the middle, I've got the SPY with dividends. This is a total return. This is the default at stock charts. If you just enter SPY or any ETF or stock symbol, you're going to get the total return. And that's important because if you're long in the market and a dividend comes in, you get that dividend. It's part of your return. So that's why you need to include it when you're looking at some sort of a system or a strategy. Now, here's the catch. If you look at SPY with dividends, you didn't get a close below that 200-day. So it's not exactly like the S&P 500. There was no close below the 200-day in April. And then the bottom window shows SPY without dividends. And to do that, you do underscore SPY as the symbol. And you can see we had a close below the 200-day in late March and in early April. So we had two closes below the 200-day for unadjusted SPY. So that's kind of confusing. Now it's like, okay, which index or ETF do we use to measure the broader market? Well, as far as I'm concerned, it's still the S&P 500. It's still the most important index out there. It's the most widely followed. You know, major fund managers and institutions aren't benchmarking to SPY. They're benchmarking to the S&P 500. And you combine the most widely followed moving averages, 50-day and 200-day, with the most widely followed benchmark. Maybe it's a self-fulfilling prophecy, but it is what it is, and we should take advantage of it as long as it works. And what is working is the S&P 500 and the 200-day SMA. So again, here's this chart. Now, for the testing that I'm going to do now, I'm going to use SPY. And I'm going to use the dividend adjusted SPY. So we're going to see how dividends help our returns by, when we're invested, we're collecting those dividends. So if you'd use the S&P 500 for signals, buy above when it crosses above the 200-day SMA, like here, and sell when it crosses below. Of course, you didn't write it all the way here. You had some whipsaws, and that's going to happen. But you had 171 crosses, which is 86 signals or trades. But if you had bought and sold SPY using this, you would have had a compound annual return of almost 8%, and your drawdown was half of what it was, what I showed you with the S&P 500 buy and hold, 26%. Now we can smooth it even further. If you just smooth that closing price by taking a 5-day simple moving average, and you use the 200-day simple moving average, instead of 171 crosses, you get 67 crosses in the last 25 years. Fewer signals, 104 fewer signals than before. And how did that return? Well, if you bought SPY and sold SPY using that for signals, you had a 7.6% return. Okay, it didn't beat the previous system using the 200-day moving average and the close, but it had a lower drawdown, 21%. And that's what we're after. We're looking to reduce drawdowns. And if you have fewer signals, you're trading less, and that also helps. Well, let's take that a step further. Let's look at the 25-day simple moving average with the 200-day simple moving average. And you can see it's even smoother. You're getting some whipsaws still here, but you're definitely out during the bear market, and you're catching most of the bull runs, especially these last two bull runs we had in the S&P 500. So now we're down to 33 crosses in 25 years. That's a little more than one per year, which is much more tolerable than 171 crosses. And if you had bought SPY when the 25-day SMA crossed above the 200-day SMA, and you sold when the 25-day SMA crossed below, you would have had an 8.76% compound annual return and a max drawdown below 20% of 19%. So if you look at the signals roughly, yeah, you had some whipsaws, and especially in 2015, but we all got whipsawed then. But you were out of this bear market in 2008 and 2009. And you're out of the bear market in 2001 and 2002. And that's the reason we use these moving averages, to keep us on trend, on the right side of the market. All right, now we're going to take it one step further with the granddaddy of them all, the 50-day SMA and the 200-day SMA. And you can see it gets even smoother, and you get even fewer signals. There are only 23 crosses in 25 years, less than one per year. That is almost a passive system, if you will. But look at the results. If you had bought SPY when the 50-day crossed above the 200-day, a golden cross, and you'd sold SPY when the 50-day crossed below the 200-day, the death cross, your compound annual return would be around 10%. And your max drawdown is below 20%. So clearly this keeps you on the right side of the market and in the bigger trends. Now with all moving averages, you're never going to catch the bottom. All right, here's the bottom in March 2009, and it's several months later and a lot higher that the cross occurs. And if you look at this bear market, the peak was in 2007, but the cross didn't occur until a few months later at a lower price. So if you take a longer term perspective, it looks great. But when you're looking at it short term, it looks like you're missing a big move. But in reality, you're just going with the trend. You're trying to pick the right side of the market to be on. And that's what this is to be used for. So I put all these numbers together in a table so you can see how it works and how everything compares. Now, I don't want you to glaze over. I'm going to highlight individual columns and things here to point out. But first, we've got buy and hold. And this is for SPY over the last 25 years, including dividends. Remember, we're using the S&P 500 for the signals, and we're trading SPY. So you buy when the close crosses above the 200-day. You buy when the 5-day SMA crosses above the 200-day SMA. You buy when the 25-day SMA crosses above the 200-day SMA. And, of course, the golden cross at the bottom. And you use the reverse cross for your sell signals. Well, you see the compound annual return. Well, it starts getting interesting when you start using the 5-day and the 25-day. You see you have a higher compound annual return and fewer signals. And the best return is with the 50 200-day cross. And then if we look at the max drawdown, it starts out at minus 55%. But as we get fewer signals and we smooth out that first moving average, the drawdowns decrease. So we have less risk. And we're exposed to the market around 74% of the time in each scenario. If you look at the number of trades, we went from 86 on a simple close above and below the 200-day SMA down to 12 using the 50-day and the 200-day SMA. Now you can see with more trades, you get more losers than winners. So the close above the 200-day SMA and the 5-day SMA closing above or below the 200-day SMA, you had more losers than winners. But when you got the longer moving averages, the 25-day SMA and the 50-day SMA paired with the 200-day, you had more winners than losers. Almost 2-to-1 here with the 25-day SMA. And there was only one loser over the last 25 years when using the 50-day SMA and the 200-day SMA, and that was in 2015. So this is a really timely presentation because if we look at the S&P 500 now, we're right at the 200-day SMA. That's the red line there, right at it. And we're consolidating here. We're in a big choppy trading range. And you can see the 50 days turned down, but this system doesn't even look at the direction of the moving averages. It just looks at the 50-day crossing below the 200-day, the 25-day crossing below the 200-day, or the 5-day crossing below the 200-day. Now, I didn't show the other two, but you can kind of use it as 3 strikes and you're out. All right, so if the 5-day, which is going to be just above 2,600 here somewhere, if it crosses below the 200-day, that's strike 1. 25-day is going to be up here somewhere, probably 2,670. If it crosses below the 200-day, that's strike 2. And the 50-day, which you see here, if it crosses below the 200-day, strike 3, you're out. That's a bear market. All right, you move to the sidelines and you wait for a bull market. So the S&P 500 is what I use to keep me on the right side of the market. Now, when it comes to individual trades and shorter time horizons, sure, I'm going to use SPY, or here's the E-mini. And if you look at these two, you can see a downswing, an upswing, and a downswing. And we're still in a downswing. All right, we've been chopping around here for a little over 2 weeks now, and it's surely a mess. You know, you're getting head fakes here, you get a head fake down, and then we get a rally, and then we get another move down. And what happens within this consolidation is anybody's guess. But I'm going to say if we get a breakout to the upside here, then that's going to reverse this short-term downtrend. And then we have a longer-term uptrend in play. We're still in a bull market. So that's going to be a pretty bullish development. And if you look at the E-mini, we got a similar situation with that decline in this choppy range. We don't have today's data because it's an end-of-day chart, so it'll be updated after the close. But we need the E-mini above 26.75 there and the SPY above 267.5 to see if we're going to get this short-term downtrend reversed. And I would like to thank everybody for tuning in to the inaugural edition. Now, next week, same time, Tuesday at 10:30 a.m., I'm going to apply this technique using the S&P 500 for signals and see how it works for IJR, the small cap ETF, QQQ, and MDY, and you might be surprised. So thanks very much for tuning in, and I'll talk to you again next week.